Look at these colors. Can you see a pattern or any rhythm at all? Most people are going to say no, and they're right, because you're looking at every region in New Zealand ranked from the fastest house price growth at the top all the way to the slowest at the bottom. And buried in here is the reason I see Kiwi investors buying the wrong property at the wrong time. And I'm going to prove it to you in this video as we count down the 3 biggest mistakes I see property investors make, from the one you're probably making right now to the mistake that cost investors a decade of returns. Now, let's come back to that quilt of colors that show the regions with the fastest and slowest house price growth. And let's pick one region and follow it all the way through. So if we take Canterbury, it was number 1, had the fastest house price growth in the country out of all 12 regions back in 1992. But after that, they were all over the show. They were in the middle for a couple of years, sometimes down at the bottom, then back at the top, then bottom again, then top again. And if we look at, say, Auckland, it spent 4 years in number 1 position, had the fastest house price growth out of all 12 regions, but it has also been dead last. It's been in the middle, back to 3rd place, and Auckland's had every single seat at the table. And what this tells me is that trying to chase the highest returning region, at least for just what's going to happen next year, is completely pointless, because every single region on this chart, every single region in New Zealand has been number 1 at some point, and every region also spends some amount of time at the bottom. And most of the time, look, it averages out to somewhere in the middle between 5th and 8th place. So you can safely ignore what went up in value fastest last year, because it can so easily get knocked off that top spot. Which brings me to mistake number 3, which is home bias, which is when you invest only in the market that you know. So let's say that you live in Christchurch. So you buy your first rental property in Christchurch. Or if you live in Auckland, so you buy your first rental property in Auckland because it feels safer. It's just down the road because you know the area. But it's actually much more risky than you might think, because you might already own a house in that region. It'd be your family home. So you've already got some exposure to that property market. Buying another property in the same region, that doesn't diversify you, it concentrates you further. And the fix is really boring, and it's the same thing every good investor eventually learns, which is you've got to try and buy the whole market. Spread your risk around the regions, because you can't pick winners over the short term. And if you're enjoying this video, do me a quick favor, hit the like button, subscribe, and ring that notification bell. That's what I look at to decide which videos to do more of. And that brings us to mistake number 2. And I actually got thinking about this as I was walking through the airport last week, and I saw this ad for a managed fund from ASB promoting their latest returns. And the thing about managed fund providers or KiwiSaver providers is they all advertise the return. And it's like everybody is all number 1, because ASB might advertise their 3-year returns, and another fund manager might advertise their 1-year returns, and another their 2-year returns. And then magically every fund manager gets to claim that they are number 1, but they can't all be number 1. But the mistake that I see investors make is that they go with whoever put the billboard up and said that they had the best return last year. So my wife, Angela, she's a financial advisor specializing in shares and funds. So you can imagine what we talk about around the dining room table on a Sunday morning. And a few weeks ago, she was sitting there and was like, come look at this really cool graph. And this great Kiwi company looked at what would happen if every single year for about 15 years, you sat down and asked one question: which managed fund provider got the highest return last year? And then what you do is you switch your KiwiSaver or your managed fund across to that investment fund, because they got the highest return last year. And let's say that was from Milford. Okay, sweet, we're switching our money across to Milford. A year later, you sit down again and you check, well, who won last year? Who got the highest return? Well, turns out this year it might not have been Milford, it might have been Fisher Funds. So, okay, we're going to switch our KiwiSaver, we're going to switch our managed funds across to Fisher Funds. And you just keep doing that year after year, always chasing whoever won last year. 15 years in a row you do this for. And what this company did is they then looked at what would happen if you did the exact opposite. What if every year you switched to the fund manager with the lowest return from last year, the absolute loser? So you go to the company who's got their tail between their legs, and 15 years later, who wins? Chasing the winners, chasing the people with the highest return, or chasing the people with the lowest return? Well, you wouldn't believe it. It turns out you would have made slightly more money switching to the losers, the companies with the worst returns last year, rather than the companies with the highest returns. And that happens because if a fund had a huge return last year, it's probably because whatever it invested in went up in value. But then it's already gone up in value. Those gains are already baked in and you're potentially buying at the top. On the other hand, the funds that had a really bad year, they might have some catching up to do, so the assets they hold have the potential they might bounce back. Now, it doesn't mean it always happens, but I'll give you a good example of where this has gone wrong. So in 2020, there was the ARK Innovation ETF, and that specific fund rose by 150%. Now, a whole heap of retail investors, they globally poured into that fund because they're chasing that high return, right? In fact, I think they raised like $29 billion over 2020 and 2021 because so many people wanted to chase those high returns. Then, a year later, in 2022, the fund fell by around 67%. And that's mistake number 2, where you look at what happened over the last year or the last 3 years and think that that is going to keep happening. If a fund manager got a good return last year or over the last 3 years, it actually tells you absolutely nothing about the return that you might get over the next 3 years. And look, I understand that this is a property investing channel, right? So you can bet that this happens in property too. A region might have a boom in house prices. It runs hot for 3 years. Everyone's piling in. The Trade Me headlines start writing themselves and you think, this is the market I've got to buy into because it's booming right now. Except it might not be the one to go for, because if a region has just had a huge run, you could be buying at the top, which is why I built you this model to help you spot this. I'll give you an example of how it works. Let's say we look at the cheapest region, or what's often the cheapest region in New Zealand, which is Kawerau, which is a tiny little council area in the Bay of Plenty, completely landlocked by the Whakatane district. Now, Kawerau is currently one of the cheapest places to buy a house in the country. The average house price there, depending on the numbers you look at, about $404,000, which is 45% of the national average house price, so less than half of what the average house costs in New Zealand. Sounds really cheap. But over the last 34 years, Kawerau house prices have averaged 0.33 times the national average, which basically means if the average New Zealand house was $1 million, historically, you'd expect the average Kawerau house to be about 330 grand. But right now, Kawerau house prices aren't that. They're higher. They're 0.45 times the national average. So house prices in Kawerau are currently expensive for Kawerau, and by my model, the region looks about 35% overvalued. Now, this model can't tell you when house prices will go up or down, but it can give you a sense of where a region is within its property cycle, and my read of this is that Kawerau is near its peak, so I wouldn't anticipate that house prices are going to continue outperforming over the medium term, over the next 5 to 10 years. Now, an area that appears to be undervalued rather than overvalued like Kawerau, that would mean that it either hasn't gone up in value much over the last, say, 5 to 10 years, or it might have actually gone down in value, perhaps more than the New Zealand average. But that's where Warren Buffett has a line that I think fits this situation exactly, which is be fearful when others are greedy and greedy when others are fearful. And this calculator can give you a sense of whether buyers in a specific market are being particularly greedy or fearful. And you can use this for free. The link's going to be down in the description. But if you want to start applying this kind of thinking to your own portfolio, you really should talk to a financial advisor before you invest in property. And if you're looking for a starting point, you might check out my team at Opus Partners. You can find out what that involves by clicking the link in the description or scanning the QR code on your screen. And that brings us to the number one mistake I see investors making. And this often happens when you've already realized that looking at the returns from last year is too short. And you might already know that 3 years. Yeah, that's too short as well. So you think, I know what I'm going to do. I'm going to look at longer windows. I'm going to look at the returns over the last 10 years, 20 years, 30 years to see what might happen in the future. But even a 10-year window is not a very good predictor of the returns you might get next. And the mistake I see most often is that Kiwis are looking at 10, 20, 30 years of past returns and thinking that is exactly what they can expect to get going forward, guaranteed, locked in, same numbers ahead. And it just doesn't work that way. Lots of finance creators I see talk about like the S&P 500 and saying it's averaged 8.5% a year for the last 30 years. And the reason that everyone quotes that kind of number is that it's really easy to calculate. You take the starting point, you take the end point, you run a quick calculation, done. But what's much harder to calculate is what that means for you going forward. Because the truth is, if you bought into an S&P tracker fund at any point since 1992, the same window I use for property, and just rode the market for a decade, only 40% of the time would you get at least an 8.5% increase in value each year before fees. So let's say you were investing in March 2002. Look back at the previous 10 years of returns, the S&P 500, it had gone up by 11% a year on average. But over the 10 years that followed, you only got 2.1% a year on average. Then say you looked at that 2.1% in 2012 and decided, oh my God, that's my future. The S&P 500 is not going to do particularly well, so I'm not going to invest. Well, you would have missed out because over the next 10 years, you would have averaged 12.4% a year. And the point isn't to bank shares or to tell you not to invest in funds, because it's honestly much easier to dollar cost average in shares and keep buying throughout the cycle. So my point is that you can't look at the previous 10, 20, 30 year growth rate and think that that is the return you're definitely going to get going forward, because over those last 34 years, if you were going to buy and hold for a decade, only 51% of the time has the S&P 500 appreciated by 7% or more over that period. So only half the time did the S&P 500 deliver that much lower bar than the 30-year average. And we can apply the same type of thinking to property, which is why I built another calculator for you. And this time it compares every New Zealand region's growth rate over the last 10 years with that of the next 10 years that followed. And I like this because it shows you how not guaranteed returns are. So if I wound back the clock to 2016, Auckland house prices had gone up by 7.5% a year on average. So over the past decade, like massive growth. Over the next 10 years that followed, Auckland grew at 1.9% per year, almost 4 times slower. If you'd bought based on the past 10 years worth of returns, you would have felt like a genius on day one when the market was still hot, and perhaps like a mug 10 years later. Now, the opposite happened in Invercargill. So if you'd looked at the prior 10 years back in 2016, Invercargill had some pretty sluggish growth. House prices there grew by just 2.9% per year over that decade. But in the 10 years that followed, Invercargill boomed. It grew at 9.7% per year, about 5 times faster than Auckland during those same 10 years if you measure it on an annual basis. So the long-term compounding return, however you define long-term, does not guarantee the returns you get with your investments going forward. Because if you measure that long-term return starting at the bottom of a downturn and then ending at the top of a massive boom, that return's going to look huge. If you measure it from the top of a boom to the bottom of a downturn, that return is going to look really small. The long-term return is not one fixed number. It depends on where you start and stop the clock. And this is just me trying to help you think as a counter-cyclical investor. So don't ask what a region has returned over the last 10 years. Ask where its price sits compared to its own history. And I'm not trying to say don't look for clues about where property prices might go up and down next, because I literally recorded this video about what always happens before a property boom, which you've got to check out. Click the video on screen and I'll see you in there.